Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Ryan McCormack, Factor and Core Equity Strategist over at Invesco for a weekly review of the Nasdaq-100. We'll also take a look at jobless claims and what that means for Fed policy. Ryan, it's great to see you as always, and I would like to note that we are firmly in the green on the Nasdaq-100 today, Wednesday, December 21st, our last hit of the year, you and I. What happened week over week in the index?
Well, not much green over the past week. I'll tell you that much. We saw QQQM and QQQ underperforming, down 6.41 and 6.4% respectively. S&P 500 down 4.89% for the last week of trading, and S&P 500 value down 3.94%. And we kind of saw the performance slide begin in real time last Wednesday as we spoke just after the Fed decision and press conference that took a decidedly hawkish tone and weighed on stocks for the week.
And if we take a look at jobless claims, that kind of had something to do with it as well.
Yeah, I think a lot of it points to, of course, like Wednesday, we started to see the sell-off intensify. Thursday was just a terrible day for stocks. You had QQQ down well over 3% for that session alone. And I think a lot of it can be kind of looked at from some of the economic releases. So on Thursday, we saw advanced retail sales down 0.6% month over month. Kind of an important part of the year, right? We have holiday season heading into Q4 earnings. We see consumers potentially tightening the fiscal belt in this sort of tenuous economic situation that we found ourselves in. And then that same day, we get initial jobless claims that came in at only 211,000. So, it's underscoring Powell's comments. Employment is still hot. We sort of saw the claims number rise from March, where they hit a low of 166,000, which was the lowest since 1968. And it was up, kind of creeping towards that 260, 261,000 range in the middle of the summer. But since then, we've largely seen it trending lower. And, at 211,000, that's clearly a reading that's suggesting strength in the labor market. I mean, the sort of line of demarcation between a strong and weakening labor market is 300,000 weekly claims, and we are nowhere close to that. So you sort of see this like Fed's conundrum where, there's a worry about, some of the impacts of the economy that Powell outlined and has warned against. The economy, households will have to feel some pain. And then on the other side, you have a hot labor market that may force them to continue to hike rates with, with inflationary pressures being driven by services and wages within the services side of the employment equation.
And Ryan, let's wrap up with sectors here, because since the Nasdaq-100 Reconstitution, we're starting to see more representation across sectors in the index.
Yeah, so I mean, plain and simple, information tech and consumer discretionary were the largest detractors to relative performance against the S&P, each down 7%. Interestingly, all sectors within QQQ and the S&P 500 were in the red, other than energy in QQQ, or the Nasdaq-100, which is something new for us, right? That's a new phenomenon this week after the Nasdaq-100 annual reconstitution, which took place after Friday's close, effective Monday, and saw two energy names enter the index, Baker Hughes as well as Diamondback Energy. Alongside them, we saw CoStar Group sort of re-enter the Nasdaq 100. We saw Global Foundries enter the Nasdaq 100, semiconductor design and manufacturing. The electric vehicle maker Rivian Automotive entered the index, as well as Warner Brothers Discovery. Discovery was previously in the index as a standalone company, but Warner Brothers and Discovery merged earlier in the year and made it into the Nasdaq 100. So interestingly, we've got two new energy names within the index. We saw 6 companies leave the index and move down to the Nasdaq Next Generation Index, which is the 100 largest companies listed on Nasdaq X Financials, just below the Nasdaq 100. And that includes Baidu, DocuSign, Match, Splunk, Skyworks, VeriSign. Now, that being said, it's not always bad news. On average, the 12-month return after being moved down to the Nasdaq Next Generation Index was 18.6%, with a median return of 10.5%, with 18 of those companies eventually making it back into Nasdaq 100.
All right, Ryan, appreciate the insight. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.